You're listening to the Payments Perspective podcast, where we help you navigate your payments journey one episode at a time. WestPay supports over 800 members, from financial institutions to fintechs, through expert education, guidance, and over 50 years of payments expertise. Let's dive in.
Welcome to the Payments Perspective podcast. My name is Jeff Duffy, Assistant Vice President of Education and Events here at WestPay, and I'm pleased to be joined today by our guest, Trevor Lain, CEO at LexAlign. And in this episode, together we're going to unpack Nacha's new fraud monitoring rule amendments, the challenges of scaling originator oversight, striking a balance between education and enforcement, as well as how automation and artificial intelligence can help our teams effectively meet these rising compliance demands. So before we get started, Trevor, will you please introduce yourself and tell us more about LexAlign?
Sure. Thanks, Jeff. Trevor Lain. I was an attorney for banks for many, many years, mostly in times of crisis, so kind of high-stakes situations. I was brought in to help not only deal with the auditors and examiners, construct consent orders, but also to help with operational issues that ensued in times of regulatory change and a lot of upheaval in the market, oftentimes trying to help banks and other financial institutions understand what the law required in practice and how to operationalize it. I began to see an issue that was common to, it was kind of a common thread starting around 2008, which is how exposed banks are to the operations of small and medium entities' operations. And it's really an outgrowth of the technology transformation of banks, where a lot of basic banking operations that 30 to 40 years ago were exclusively handled in the inner environment of the bank had sort of migrated out, but we lacked a way to obtain and maintain visibility on them and to empower the people handling the operations to make sure that they were handling them in a way that managed the rules, risks, and responsibilities. And so I saw a gap that could only be solved by automation, and that was the genesis of the idea for LexAlign to enable financial institutions to manage remote operational risk, where those operations are handled by less sophisticated parties, say customers nowadays, very much so in the era of fraud, but also potentially vendors and partners.
First thing I want to talk about is how we've seen a major shift from debit-based fraud to credit push fraud, which includes those business email compromise, authorized fraud, and other faster payments scams. So how has evolution changed the way financial institutions and their business clients should be thinking about their payment risk management today?
Okay, well, thanks for the question. I think we need to consider operational risk at the periphery, in line with what I just said. With credit push fraud, the customers are now the front line of fraud. To the fraudsters, they're the front door of the bank. So bad actors have figured out how to get around the on-site fraud detection systems by penetrating and watching the originator for an ACH transaction, and then getting them to send or create authorized credit transfers that end up at fraudulent accounts, but that match what we expect from the client, oftentimes irretrievable by the time we realize something bad has happened. The key point is that how we should think about this evolution, and that's that we need to shift our attention to what I call the front line, to helping customers manage the risk of their operations. And that means really looking beyond transaction monitoring to customer compliance and security. And why do I say compliance? Because most of the rules that apply to customers are really designed to prevent fraud and other losses. So if we focus on compliance, we're really helping ourselves in the fraud scenario. And as I said before, I think this is an inevitable evolution of the migration of basic banking operations that occurred with that technology revolution from banks. And I'm sure we're going to come back to that issue.
Okay, so yeah, you mentioned the monitoring that is essential from the institution's perspective. Nacha has these upcoming fraud monitoring rules that are going to be going into effect in 2026, and it's going to place increased responsibility on our originators and on their ODFIs to verify by that appropriate oversight in their originators' compliance with these amendments. So what do you see as the biggest operational or compliance challenges that financial institutions are facing as they work to adapt to this rule and they do to meet those challenges?
So as you said, this is a challenge, and the challenge is how to manage the risk of those remote, dispersed operational settings. We can't do this manually at scale, no matter how big our institution is. And as with other banking operations that that were regulated under the Bank Secrecy Act, which is what these are ultimately, the delegation of the operation to a third party does not discharge the bank's or the credit union's responsibility for the compliance. And that's in conformance with Nacha's general rule in Article 2. And as you said, you used the word verified, and that's actually cited by Nacha in the FAQs for the new fraud monitoring rule. They're expecting the compliance and the responsibility of the customers to be verified by appropriate oversight by the ODFI. And so obviously there's a challenge here. Now, a couple of points about compliance. First of all, compliance is about records. Now, as an attorney, I say that because at the end of the day, it's about demonstrating that we're in alignment with the rules and showing something that was required to happen did happen, or that something that was prohibited was prevented from happening. And for information to meet that standard, we must be able to stand up in an audit, exam, or legal action, which means it must meet the rules of evidence, an issue that we're going to come back to later with your other questions. The second point is that, and this is some good news, compliance is not all or nothing. It's not a 1 or 0. So just like we say perfection is the enemy of good, it's not okay to say we can't possibly perfectly manage remote operations and therefore we're not going to try. We have to try. We've got to do something to show that we're making a good faith, serious effort to do that. But what does that mean? So the standard we can use is what's reasonable under the circumstances generally. And that means in light of the risk and what's available to us. Now, the risk is obviously huge. The rate of growth in fraud and fraud techniques is well beyond what we can tolerate as the cost of doing business, and it's growing. But the resources are also constantly evolving, and that means that we should be paying attention to, and where appropriate, leveraging resources that enable us to manage that risk in a better way in order to create records that demonstrates that we're making a good faith, serious effort to do it. And so just to emphasize a point, when I say good faith and serious, that means that we're what's reasonably attainable in light of what's available at the time. And so if a technology emerges that enables us to achieve a materially higher level of compliance and we don't make use of it, we better have a pretty good excuse why we're not doing that.
So on that note, we have many of our institutions that have hundreds or even thousands of originators that they work with, or even third-party senders that also are going to be required to adhere to these fraud monitoring expectations. So what are some of the practical obstacles that you're seeing when institutions attempt to scale this risk oversight and monitoring across their populations?
So let's get back to that basic point that manual efforts just can't do this at scale at any reasonable cost. And risk management needs to be not just proactive and effective, it has to be efficient. So we need to be proactive. That's the nature of the rule, not just detect fraud, but the rule really calls for role-based risk management, as you know. So some transaction monitoring could be appropriate for those who are transmitters, but we also have to look at what the rule calls for authorization. If parties' role is authorization, what does that mean? How do we enable the customer to manage that aspect, since they handle most of the authorization for the transactions that they originate, to make it attainable? So it has to be efficient. So we said proactive, effective, and efficient. You're going to see I'm going to use some adjectives that end up being sort of a checklist. Risk management of remote operations doesn't mean that we need to spend the same amount of time on everyone. A common theme in regulatory guidance is risk-based risk management, and that's in the new rule itself. And that means it's okay to prioritize our efforts on the actors or operations that present outsized risk. So we can add targeted to our list of adjectives. We need to do targeted risk management. But to do targeted risk management, we need data. We need data to determine which remote customer operational setting presents the most risk, presents outsized risk. And to date, we've relied on indirect data to determine that. And by that, I mean transaction monitoring and monitoring for return rates. Now, transaction monitoring is useful to detect some kinds of fraud, and it is a tool that banks and credit unions should have. But it's not a great tool for remote compliance management. And as we discussed, bad actors are using sophisticated techniques to mask their fraud as legitimate and expected customer transactions. Monitoring return rates, on the other hand, is an indirect measure of certain compliance risks like authorization gaps, and therefore particularly useful for debit fraud. But in the era of credit push fraud, it's not a great way to determine where we need to spend our precious energy and resources on proactive risk management. And our most active ACH customers, or those with the highest return rates, might not be the ones that ultimately present the greatest risk to the financial institution in the event of credit fraud. So without specific data on customer compliance and risk management, there's no way to do proactive, targeted, efficient, and effective risk management of remote customer operations at scale. And we don't have the data we need to determine where to spend our time. We can't set up routines without the relevant data triggers. So the key is that for credit fraud, we need more precise data on remote operational compliance and security. And that's what I see as the key challenge. Now, again, fortunately, new technologies are emerging that bring relevant data to us to enable remote operations risk management and we can avail ourselves of them. And incidentally, not coincidentally, that's why, we created LexAlign in order to create that data flow. So customers getting information they need to empower them to understand where they have gaps and how to remediate it in their compliance and security, but also bring information and scoring from the customer back to the bank so the bank can demonstrate and enable this proactive and targeted, effective and efficient risk management at scale. I would say the last thing I would say is there's no one tool that's going to suffice under the new rule. It's really going to take a toolkit approach. And so we shouldn't rest on our laurels and say, well, we have this one tool and it's doing fine, because the rule has different facets to it.
That it reminds me of the fact that Nacha and we've been telling our members the fact that there is no one size fits all. And I think what you were saying really reinforces that, because it's gonna be a solution or series of solutions perhaps that we're implementing based on the data that we're getting at our institution. Just because at my credit union they're going to do one thing, they might be doing something different at my bank based on that data, if I'm understanding you correctly, based on the data that shows where that risk is, which helps determine how to best combat that fraud and fill those gaps. Am I following there?
I think you are. There's two different aspects there. The data I was just talking about are data about the customer compliance. And so determining which customers we really need to spend time on by looking at that aspect and also our own sense of which customers, by nature of volume or by nature of the types of transactions they're doing, present the most risk to the bank. So a risk-based risk management depends on several, I would say, axes of determination. One is how much, what are our resource availability? And as you said, different size institutions have different resource availability, but everybody's constrained. The other is, where are our risks in general? In some institutions, ACH can be a greater risk point than in other institutions, just depending on what their exposure is. And so there are different ways to determine what resources we allocate. My point about data was really, how do we effectively manage the risk of remote customer operations without the data as to know where to spend our time? And so in order to do it effectively and in a targeted and proactive way, we need data up front to determine which customers represent the most risk. And it might not be the same as just which customers have the highest volume of transactions or even the highest return rates. That's my point. There's another set of data we need.
Okay, it totally makes sense.
Yeah.
So when it comes to implementing these fraud controls and enforcing those compliance requirements with our clients, there can often be that tension when our institutions work with and educate their clients about these new requirements and other requirements, of course. So what can institutions do to strike the right balance between being partners in fraud prevention along with maintaining that strong oversight?
Okay, I would say let's start by recognizing that it's fundamentally unfair to ask someone to play a game without explaining to them what the rules are in a way that's accessible to them, and then faulting them for not following those rules. So I think the key to ultimately holding a customer accountable is by making the rules accessible, pertinent, and actionable to them. Again, using adjectives as checklist items. So accessible, pertinent, and actionable. What does that mean? It means instead of giving the originator a 700-page book of rules and saying good luck, and then holding them accountable, which for the majority of the customers is not going to work. It's unreasonable, and it's I would say, unfair. So we have to make clear to them which of the rules, risks, and responsibilities actually apply to them and what that means in practical terms. So we need to empower them to do their own risk management, and then we can hold them accountable. And so to do that, we need to assess, first of all, which risks are actually implicated by their operations. And that means asking them on a very base level what they're doing. And so instead of saying, we permit you to do PPD transactions, so we're going to test you against the rules associated with PPD, we need to actually understand what kinds of transactions they're doing, because they might not be doing solely PPD transactions. They might be doing some telephone collections. Their business might have evolved into an online sales. And so they could be doing tele or web transactions, even though we're only giving them access to PPD as an SEC code. And so it doesn't help to ask them these sort of high-level leading questions. We should ask them granular questions that we know they can answer, which is about what are you actually doing? And then determine from that which rules apply, and then take them through analysis. And that's incidentally what LexAlign does in an automated way. It first determines which rules, risks, and responsibilities apply, and then takes the customer through an assessment of their compliance in order to build for them the kinds of information they need fundamentally to manage that risk. So here's a gap analysis, here's an action plan, here are policies and procedures, here's a remediation checklist, all online, all accessible, no matter how sophisticated they are. And then in order to score them and bring data back to the bank. So I think in sum, make the rules accessible to the customer and actionable, and then assess them based on that, giving them the opportunity to show remediation as well.
Gotcha. Yeah, I think that's definitely key, that education part of it. We often sometimes just think of education to our staffs at our institution, but it's so critical that we push out that same or the appropriate education to our originators that we're offering these services to. So that makes a lot of sense. So I think we can all agree that at our organizations, that even though the demand for treasury services and the need for effective risk management is growing, our treasury and risk teams are frequently under increasing pressure to do more, but with fewer resources. So what do you see that automation, data, and artificial intelligence can do in helping institutions meet their rising compliance expectations without burning out their teams?
Yeah, these are key points. And burnout is very real. And we rely on these people because they're highly trained and valuable to us, and in high demand as well. I don't think there's any way around automation. I think in order to do this at scale, we need automation. But as I said, compliance is about records. And records have to ultimately be able to meet the rules of evidence, because at the end of the day, we might find ourselves in a situation where we're defending what we're doing in a court of law or in some sort of similar setting. It's key to know that basic data gathering should not be based on AI, because AI does not create records that meet the rules of evidence. There's just not that certainty yet with AI that what the output actually absolutely means a certain input, certain things that happen. So we can use more traditional algorithmic automation to gather data and create records that we need to demonstrate that we're managing this risk. And let me also step back for a second and say, when does compliance really matter? Compliance really matters when something bad has happened. You've suffered a loss, and now you're at a crossroads where the scrutiny is going to increase. The customer might be disgruntled and threatening a suit. And now is a time when having the records can make a huge difference into what the magnitude of the ultimate loss and the cost of the fraud is. So we talk about noncompliance being a compounding factor on risk rather than the same thing as risk. And again, compliance means records. So having those records enables us to say in those times, sometimes bad things happen to good people. We were doing good. We can show that what we were doing is in alignment with the expectations and the rules on us. And that can protect us massively against downside losses that can come from a finding of noncompliance. Now, AI does have a role, though, in risk management, and not only in tools like behavioral monitoring, where we're looking for patterns. It really helps us to find patterns or other insights in the data that we're otherwise gathering that can help us with risk management going beyond human abilities. So where we can use AI and automation is not just in creating the records, as I said, for automation that's algorithmic, but also in ensuring that we are acting on the data appropriately. So that's building processes internally at the bank to act on these data triggers, these flags, that are coming to us, but also to take dispersed sets of information that might be coming into the institution from different portals and analyze them together to find those patterns that indicate a risk of fraud that we can act on proactively. So there's a role for all of this. I would say it comes down to technology and automation.
So Trevor, as we wrap up our time together, do you have any final thoughts that you'd like our audience to take away from today's conversation?
Just that, stay connected with your payment association. They're a great resource to understand what's not only the new rules and the risks that are evolving, but also what solutions are available, and try to stay current with the solutions so that you can stay ahead of the fraud and ahead of the risk. That's what I would say.
Thank you, Trevor, so much for joining us today and for the insight that you've shared with our listeners and who will definitely benefit from hearing from you today. If anyone listening would like to get in touch with the folks at LexAlign, their contact information will be made available in this episode's description. I want to also thank our members for listening in, and if you're not a member, but you're interested in joining WestPay, please visit our membership page by following the link included in the description. And remember to subscribe to the Payments Perspective podcast anywhere podcasts are available for streaming. And please join us again next time as we continue to work together in shaping the future of payments.